Welcome to this Handtech Markets video on expanding your trading opportunities. It's often said that humans only utilize a small percentage of their brains. While that isn't entirely accurate, it is true that most traders only take advantage of a small percentage of the opportunities that are available to them. In equity markets, there's a well-known phenomenon known as home country bias. This results in traders preferring to invest in companies from their home market, primarily because these are companies they're most familiar with. The same applies in FX markets. Traders tend to have a bias toward trading their home currency, usually against the US dollar. So people from Japan are likely to have a preference for trading dollar-yen. People from Mexico are likely to have a preference for trading dollar-Mexican. And people from New Zealand are likely to have a preference for trading Kiwi-US. Of course, in addition to their home currency, most traders will readily and willingly trade the majors, such as Eurodollar, Dollar-Yen, Sterling, and Dollar Swiss. That's all fine, but it only represents a small selection of the 50 or so currency pairs available on your Handtech trading platform, to say nothing of the commodities and equity indices that are also available. Every 3 years, the Bank for International Settlements conducts the Triennial Central Bank Survey of Foreign Exchange and Derivative Market Activity. It's widely regarded as the most comprehensive and internationally consistent information on the size and structure of the global foreign exchange markets. This pie chart shows the share of global FX trade for each of the top 10 most frequently traded currency pairs. While it's no surprise to see that Eurodollar is by far the most traded currency pair at 28%, it might surprise you to see that the top three pairs, Eurodollar, Dollar-Yen, and Sterling US, together account for just over half of all global FX turnover. Many people are also surprised to see that Aussie-US is rated as the fourth most traded currency pair globally, far exceeding the relative significance of the Australian economy. It may be equally surprising to see Dollar-CAD in fifth position, gaining a larger slice of global FX turnover than Dollar Swiss. You can find the results of the latest survey at the Bank for International Settlements website, www.bis.org. Hopefully this data will help you to realise that if you're struggling to find a suitable trading opportunity in the 2 or 3 currency pairs that you normally trade, there are many other pairs driven by different influences and offering different opportunities while still providing good liquidity and relatively tight pricing. Alternatively, you might be attracted to more exotic currency pairs and the potential they offer for large price swings. While it's not advisable to attempt to trade too many different currency pairs at the same time, there is no need to restrict yourself to the handful that you usually trade, especially when there may be big opportunities elsewhere. Another useful tool for traders looking for trading opportunities is a calendar of upcoming economic events, specifically a calendar showing the release of official government data and statistics. This includes measures such as CPI, inflation data, retail sales, employment data, GDP, growth data, etc. This type of data is usually released at a pre-announced time and date and can have significant influence on the currency of the country concerned and sometimes on the trading partners of that country. When considering a trade based on an economic data release, it's important to understand how the market is likely to react. For major releases in particular, there is often advanced speculation as to what the result might be. In many instances, the forecasts of numerous economists and market pundits are filtered down to produce a market consensus forecast or expectation. When the data is actually released, markets will react to the difference between the market consensus forecast and the actual result. For example, from time to time, you'll see an apparently perverse situation where a currency will strengthen on the release of what appears to be weak economic data. This may reflect a situation in which the actual data is indeed bad for the currency, but not as bad as the market consensus forecast had indicated it would be. Some traders looking to expand their trading opportunities adopt an always-in strategy. This involves keeping a small position open in the market at all times. This has the dual benefit of making sure that you don't entirely miss any particular move in the market, as well as providing you with the incentive to actively monitor the market rather than ignoring it and missing big moves. Of course, on the flip side, there is a risk that many of these small positions may wind up being stopped out for a loss. However, as we discuss in the video on capital preservation and reward to risk ratios, an account can suffer a very high percentage of losing trades and still be profitable if reward to risk ratios are managed correctly. Another way traders can expand their trading opportunities is to investigate swing trading. As detailed in our video on this topic, most traders are familiar with trend-following strategies and longer-term buy and hold trading strategies. These generally seek to profit by trading in one direction only. In contrast to this, swing traders are happy to take either long or short positions and will often switch from one to the other as prices advance or decline within a longer-term trend. As you can see on this chart, the longer-term downward trend is made up of multiple up and downward swings. The total distance travelled by price as it navigates each of these swings is far greater than the straight line change in price from A to B. This gives the swing trader an opportunity to extract greater profits from the market than a trader with a longer-term trend-following strategy. Finally, one way that a growing number of traders are seeking to expand their trading opportunities involves the use of trading robots. For those using the MT4 or even the MT5 trading platform, these often take the form of expert advisors. These are trading algorithms that have been constructed to take signals from market activity and automatically enter and exit trades according to a set of predefined criteria. The beauty of these systems is that once they are set up, they can be left to run 24 hours a day, all week long. For those that don't want to create their own expert advisors, there are a growing number of services that will allow you to view the trading history of other traders and, if you wish, to copy their trades automatically in your own account. While the results can be impressive, the availability of these platforms is often governed by the jurisdiction in which you live. As you can see, there are many ways that you can uncover more trading opportunities than you might otherwise encounter if you just trade one or two currency pairs on an ad hoc basis. You can look beyond your home currency in the top couple of major pairs. You can actively monitor and trade around economic data releases. You can adopt an always-in strategy, try swing trading, or even use a trading robot. Given the number of markets and breadth of tools available at your fingertips, you're in a strong position to expand the number of trading opportunities you take advantage of.